Hello viewers, thank you once again for tuning in. I'm your host, none other than Mr. Spotter Fred. I'm happy to meet you once again so that we can continue doing what we like doing most. Friends, today we are going to continue from our previous lessons in about it, to write it here. This is financial reporting. Let me write it nicely, and instead of that, let's just say financial reporting. In financial reporting, remember friends, we were looking at the group accounts. We have been looking at group accounts. We have been able to prepare the financial statement for publication for consolidation or group accounts, except the last bit that we are not cleared with. We were able to present the financial statements including the group cash flow. But now, as far as the group cash flow is concerned, we only looked at the indirect method. Now, friends, remember that what we were looking at is the cash flow statement, the cash flow statement preparation, the cash flow statement, the IS7. That's what we were looking at. Now, the aspect of the group cash flow statement, and to be specific, the direct method. Now, friends, don't forget this, something we have always been saying. According to IS7, we should present our cash flow items under 3 headings. In IS7 paragraph 14, we should talk about the operating activities. Then we also have the paragraph 6, we should also bring in the investing activities. There is paragraph 26 of I7 where we talk about the financing activities. Now, apart from all that, paragraph 18 of I17 now gives the provision that we can use either the direct method or indirect method. The indirect method is more acceptable. However, the direct method is mostly used for presentation, especially to the shareholders who have little knowledge on accounting or technicalities of accounting. So we use the direct method. When we use either direct or indirect method, then we should remember that the items presented in the investing activities and the financing activities are presented the same way. What will only be different is the direct method. Now, remember that under direct method, that is where we'll only differ. Under direct method, we only differ under operating activities with the indirect method. The direct method will simply give us the information on how much cash we have received from operations, how much cash we are paid in operations, our principal activities or revenue generating activities. How much have we received from our customers by selling goods and services? How much have we paid to our suppliers? How much have we paid for our suppliers, not only for goods, but also for services rendered? So it comes very direct. But when we come to indirect method, remember, we are to start with the net profit before tax and make the necessary adjustment of non-cash items and also those items which do not belong to operations but belong to other activities. So we have to make all those adjustments. Now, friends, today's lesson is mainly to introduce how the direct method works. And we try to do a question under direct method. I also want to bring that comparison where we want to do a question under direct method. We also try to see how it could be presented under indirect method. We'll want to look at those comparisons because we have already learned the indirect method. We have even done a question for direct method, indirect method. So we'll want to do another question for direct method, but in addition to that, it will be important to also look at the same question under indirect method. How could it look like? That's interesting. Now, friends, we go directly and talk about the direct method, right? Direct method of presentation. That is in respect to IS7 paragraph, we have it as paragraph 18. That is something that you are able to confirm that from paragraph 18 about the direct method. It has also said about indirect method, and in fact the standard as given as the format, remember. So under direct method, what will only differ, the differences with the indirect method, will only be under operating activities. That means that now in operating activities, we are only going to present the cash inflows from operations mainly based on 3 items that we are going to identify. The main 3 items, to be presented under operations. Will be A, the cash received from customers, that is an inflow, cash received from customers. B, cash paid to suppliers, for goods, cash paid to suppliers for goods. Then C, then cash paid to employees and suppliers for services rendered. So those are the 3 items, the main ones that will differentiate the direct and indirect method. Now we want to look at the format. That we are going to use. The format, let's use as the cash flow statement. The group, let me call it the group cash flow statement format, let me say direct method format. We want to look at the direct method format. As usual, we have the 2 columns. We have, I could have also said, because it's just a format, I could also say this statement that we like saying, that for the year ended, that like that. So we have the 2 columns here, friends. One of the first item we always start with is the cash flows. We start with the cash flows from operating activities. Under that, we start with the cash received from customers. Then we also have the cash paid to suppliers. Then we have the cash. We have the cash paid to suppliers and employees for services rendered. Then we have the cash flows. From operations. Then we also bring in the obvious, just like in direct method, the tax paid. Just like in direct method, we also bring in the interest paid. Just like in direct method, Then at that point now, you get the net. You get the net. Let me try to use this different color. You get the net. The net cash flows from operations, from operating activities. Now this figure goes in the extreme corner here. Let me call it A. Then after that, friends, we now move on to the obvious ones. This is just a reminder of what we have done before under indirect method. Cash flows from investing activities. Now this is the same item that we have done. Just the same item we have now done. Investing activities the same as what we did under indirect method. As we must have said, we say cash proceeds on purchase, cash proceeds on purchase, cash proceeds on purchase of cash proceeds on sale. Let me talk about sale first. Cash proceeds on sale of assets in general. That's a cash inflow. Then we have the cash paid on purchase, the cash paid on purchase of assets. That's a cash outflow. Then we also talk about the investment income. The investment income, you recognize it here. Then you talk about the dividend received. The dividend received from an associate. The dividend received from an associate, you recognize it here. Nothing else. So we get the net. We get the net cash flows. The net cash flows from investing. From investing activities. So you have it here, friends, and let me call this item B. Then we move on to the cash flows. We have the cash flows. From financing. The cash flows from financing activities. Now, you have one of the items, and one of the items is the cash proceeds on issue of shares. Then we have the dividend paid. Remember, dividend paid here, there are two. There is paid to holding company shareholders. Then there is paid to NCI shareholders. Just the same way we did under indirect method, the same way we were dealing with these items in the indirect method. Then we also have, maybe there is issue or repayment. There is issue. We can call it additional, or repayment of long-term borrowings. If it's an issue or we have received additional, we have a cash inflow. But if it's a repayment, that's a cash outflow. Then at that point in time, friends, we now get the cash flows, the net cash flows from financing activities. Now at that point, we now recognize it here as item C. Then at that point in time, friends, now we get the total there. We call the net changes. The net changes in cash and cash equivalent. For the year. So remember, friends, we are taking item A. the item A plus the item B plus the item C, so that we can get this item here in the extreme corner. So in this extreme corner so far, we have item A, we have item B, we have item C, and the sum of item A, B, C. Then we add the cash and cash equivalent, cash and cash equivalent at the start of the year. So you have it here at the start of the year. Then you'll end up having cash and cash equivalent at the end of the year. So that is the position. Remember, cash and cash equivalent is simply the cash balances, the bank balances, taking into account other cash equivalents, and also adjusting with the bank overdraft if you have it. So those are the cash and cash equivalent. You have noticed, friends, that when it comes to investing activities and financing activities, the presentation is the same as indirect method. What will only be different, as you have noticed, what is different is this item, and this item. Those three items, that's only the difference. Now, you have noticed, even as directors, we have just said it. But now, drama is, how do we get the cash received from customers? How do we get the cash paid to suppliers? How do we get the cash paid to suppliers and employees for services rendered? Now, that's where we come and say,
thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.